A $15,000 RRSP contribution can put over $4,000 back in your pocket this tax season if you use this account properly. But the problem is, most Canadians either ignore the RRSP entirely or contribute at the worst possible time and get half the refund they could have received. Let's change that. Hi, I'm Armakan. I'm a CPA in Canada who loves to talk about money, investments, and taxes. If you are interested in any of these topics, why not subscribe to the channel? So let's start with the most basic question. What is an RRSP? An RRSP is a registered retirement savings plan. The government gives this account special tax treatment, and that treatment comes in two parts. Part 1, when you contribute money into your RRSP, that amount gets deducted from your taxable income. Your income drops on paper. You pay less tax and you get a refund during that year. Part 2, while your money sits inside the RRSP, every dollar of growth is completely sheltered from tax. Dividends, capital gains, interest, none of it gets taxed as long as it stays inside the account. The trade-off is straightforward. You save taxes now, you pay tax later when you withdraw it. The entire strategy is to contribute when your income and tax rate are high and withdraw this amount when they are low. For most people, that means contributing during your working years and withdrawing in retirement. You don't need to be anywhere near retirement to benefit from this account. To open one, you need Canadian residency, earned income, and a filed tax return. Full-time, part-time, self-employed, it does not matter. If you earned income and paid taxes, you almost certainly have RRSP room available. Your contribution room is 18% of your earned income from the previous year up to an annual maximum. For 2026, that maximum is $33,810. You can check your exact room by logging into CRA My account. That number includes unused room from previous years, pension adjustments from your employer, and what you have already contributed. Always check before you contribute. If your employer runs a group RRSP or a defined benefit pension plan, their contributions and your pension adjustments reduce your available room. Take care of that or you risk the chances of over-contribution. CRA gives you $2,000 buffer on over-contributions for life. Go beyond that and you get hit with 1% penalty on the excess for every month it stays in the account. CRA does not care if it was an honest mistake. So how does the RRSP actually save you taxes? The biggest advantage of the RRSP is that it drops your taxable income in the year you contribute. Lower taxable income means less taxes. So let me introduce you to Nadia. She is 31 years old, lives in Ontario, and earns $88,000 a year. She is going to follow us through this entire video so you can see how these rules actually play out. So 18% of her income is $15,840. That is her new RRSP room for this year. If she did not use all her room in previous years, the unused amount carries forward and stacks on top of this yearly amount. At that income in Ontario, her combined federal and provincial margin tax rate is about 30%. She decides to contribute $15,000 to her RRSP. Her taxable income drops from $88,000 to $73,000. That contribution of RRSP saves her approximately $4,450 in taxes. The higher your income, the more valuable the deduction becomes. Someone earning $120,000 in Ontario has portions of their income taxed at above 40%. The same $15,000 of contribution could save them over $5,500. Same contribution, but bigger refund because the tax rate is higher for this person. One thing to be clear about, the RRSP is not tax-free. It is tax-deferred. You save taxes now, but you pay taxes on every dollar you withdraw in the future. The strategy works because you contribute when your rate is higher and withdraw when your rate is lower. That gap between the two rates is where you come out ahead. Most people do not realize that contributing to your RRSP and claiming the deductions are two separate decisions. You can do one without the other. When you contribute, your money goes into the account and starts growing tax-free immediately. When you claim the deduction, that is when you get the tax refund. You can contribute this year and hold the deduction for a future year when your income is high. For the 2025 tax year, your RRSP contribution is March 2nd, 2026. March 1st falls on a Sunday, so the deadline shifts to the next business day. This is one of the very few tools in the tax system that lets you go back in time and reduce a tax bill you have already earned. So let's quickly see what you can actually hold inside an RRSP. The RRSP is just a container. You can hold ETFs, bonds, GICs, REITs, and mutual funds inside it. As long as the investment is qualified under CRA rules, the growth is completely sheltered from tax. If you want to pick your own investments, open a self-directed RRSP at a discount brokerage instead of using the high-fee mutual funds most banks push by default. There is one advantage that most people miss here. US dividend-paying stocks held inside a TFSA get hit with a 15% withholding tax that you cannot recover. Inside an RRSP, that withholding does not apply because of the Canada-US tax treaty. If you are buying US dividend ETFs, the RRSP is a better home for them as compared to a TFSA. You can withdraw from your RRSP at any time. There is no lock on the account, but every withdrawal comes with two costs. The first cost is tax. The moment you withdraw, your bank withholds tax immediately. Up to $5,000, they take 10%. Between $5,000 and $15,000, they take 20%. Above $15,000, they take 30% right off the top. And this is just a prepayment. When you file your return, the withdrawal stacks on top of your employment income and you could owe even more. The second cost is more permanent. Once you withdraw, that contribution room is gone forever. It does not reset the next year. But there are two exceptions where you can withdraw without immediate tax. The home buyer's plan lets you pull up to $60,000 tax-free for your first home. The second is the lifelong learning plan that lets you pull up to $10,000 per year for a full-time education. Both of these require repayment on a set schedule. I have dedicated videos for each of those programs in the description. For everything else, treat the RRSP as the last door you open. Look at your TFSA or non-registered accounts first if you need money. Your RRSP has an expiry date. By December 31st of the year you turn 71, you must close it. Most people convert it into an RRIF, a registered retirement income fund. Your investments keep growing tax sheltered, but you are now required to withdraw a minimum amount every year. That minimum amount increases as you age. At 72 years, it is about 5.28% of the account value. By 90, it climbs to almost 12%. These mandatory withdrawals count as taxable income. If you have a large enough RRSP, these forced RRIF withdrawals can push your income high enough to trigger OAS clawback. Check this video out on more details on OAS. There's also an advanced strategy called an RRSP meltdown, where you draw down your RRSP between 60 and 71 years of age before the forced minimums kick in. That deserves its own video and I will link it in the description below. Another important question is, what happens to your RRSP when you pass away? When you die, CRA treats your RRSP as if you cashed it all out on your final day. The entire balance gets added to your final tax return as income. The exception is if your spouse or common law partner is named as beneficiary. In that case, the RRSP rolls over tax-free. Make sure the right person is named. Do not leave this to chance. When we discuss RRSP, we need to discuss how it compares with other government savings accounts like TFSA and FHSA. The details are covered in another video, but for now, let's quickly see which one you should prioritize. The RRSP gives you a deduction when you contribute but taxes you when you withdraw. It works best when your income is high now and will be lower later. The TFSA gives no deduction upfront, but withdrawals are completely tax-free with no strings attached. If you withdraw, the room comes back the following year. The FHSA gives you a deduction when you contribute, and withdrawals for a qualifying first home are completely tax-free with no repayment required. It combines the best of both accounts, but only for buying your first home. So this is my decision framework. If you are buying your first home in the next several years, FHSA first. If your income is high and you are focused on long-term wealth, RRSP. If your income is lower or you want flexibility, TFSA. For most Canadians serious about building wealth, you end up using all three. The order depends on your income, goals, and timelines. At the start of the video, I told you that a $15,000 RRSP contribution can put over $4,000 back in your pocket. That is true for anyone who has extra cash sitting in their checking account. Run the numbers on what a contribution would save you at your tax bracket. The math will do the convincing for me. The two videos on the screen will take you further in your financial journey. Check them out and I will see you in the next one.